Everyone's looking for the summary of the economic projections and obviously the dots. What might we hear that might surprise us, if anything, tomorrow?
I think the only real way to surprise markets at this point would be to get the median number of hikes up to 4 next year. The market obviously is expecting a rate hike today. Futures prices suggest around a 70% chance of a rate hike in March. So I think you'd have to get above and beyond that. So you're going to need probably 4 FOMC members who are projecting 3 hikes to move into the 4 hike camp to get markets on the surprised side today. I think the odds of that are low. I still think we have potential tax cuts in front of us. We have concerns about inflation, which won't be resolved until March. So I think we need a little more information before the committee will get more aggressive.
Traders not even pricing in 2 rate hikes for next year. So if we're surprised, what impact will that have on the yield curve?
Well, you could see, you need the front end would be selling off a little bit. Generally, we've been in a flattening environment where any further normalization is flattening the curve. So I think it would reinforce that trend. There are some who think the 2-year yield is what should be under the most pressure. Others say in a world where you get tax cuts and a large deficit widening package, maybe it's more the 5-year, but the front end of the curve would be under pressure.
Michael, you won't be able to see this unless you're watching your Bloomberg there right beside you, but I want to point out chart 154 in our chart library to viewers. It shows the central bank's balance sheets, Japan, the Fed and the ECB, as a percentage of GDP, and obviously it's like a fan, it's fanning out. If and when we do get serious synchronized policy tightening, what does it mean for investors? Do bull markets go away?
Certainly, I think what we would say is it moves things from the supportive category to the not supportive category. If we look at the forecast of our Japan team and our European team and even the Bank of England, central bank balance sheets of those 4 economies, including the U.S., as a share of GDP, still rise through the end of 2018. So even though the Fed is shrinking, on net, central bank balance sheets are still increasing. It's not really until 2019 that turns. So it may be a little further out, but as you get further into 2018 without other catalysts for equities. Global growth may not be accelerating the way it did this year. Maybe the Fed keeps tightening, and then other central bank balance sheets turn. So risk assets may get a little bit of a drag as we move further into next year if that central bank support isn't there. In the very near term, I wouldn't look for that type of reaction.